Let me ask you something real quick. Have you ever opened a chart, saw a perfect setup, entered the trade, and then the price instantly went against you? Not slowly, not politely, instantly. If that's ever happened to you, don't skip this video. Because today, I'm going to explain something that most people never truly understand. Who actually moves the crypto market? And no, it's not news. It's not retail hype. And it's definitely not random. If you want to understand crypto markets instead of just reacting to them, subscribe now. This channel is about clarity, not hype. Now, very important disclaimer before we go further. Important disclaimer. This content is for informational purposes only and does not constitute financial or legal advice. Alright, let's break this down properly. Most beginners believe crypto works like this. People buy, price goes up, people sell, price goes down. That's partially true, but it's not the full picture. Because crypto actually has two markets running at the same time, the spot market and the futures market. And here's the key thing most people miss. Price is discovered mainly in the futures market, not in spot. Spot is where you buy the actual asset. You buy Bitcoin, you own Bitcoin. Simple. Futures is where people trade contracts, often with leverage. You don't need the asset, you just bet on price movement. And leverage changes everything. When leverage enters the game, the market stops being just supply and demand and becomes a liquidity game. Because in futures, people don't just lose money, they get liquidated. And liquidations are forced market orders. That's fuel. Here's where it gets interesting. Large players don't need the price to go up or down. They need people to be wrong with leverage. That's why you'll often see this pattern. Price moves slowly in one direction. Everyone starts entering. Confidence grows, leverage increases. And then, boom. A sharp move in the opposite direction. Not because the trend changed, but because liquidity was collected. Most retail traders think, why would the market do that? It makes no sense. It makes perfect sense if you understand futures. Because when too many people are positioned the same way, the market becomes fragile, and smart money exploits fragility. This is also why you'll hear phrases like, the market hunted my stop. Your stop wasn't hunted personally. Your stop was just part of a cluster, and clusters are visible. Funding rate, open interest, long-short ratios. These are not secrets. When funding is heavily positive, it means most people are long and paying to stay in the trade. That's not strength, that's vulnerability. If this is already clicking for you, drop a comment saying, this explains a lot. It helps more people see this video. Now let's clarify something important. Spot traders and futures traders are not enemies. They just play different games. Spot is about time. Futures is about timing. Spot allows patience. Futures punishes hesitation. The biggest mistake retail traders make is using futures with a spot mindset. They hold losing positions. They hope, they wait, and the market doesn't reward hope. Another truth people don't like hearing. Most big moves don't start in spot. They start when futures positioning becomes unbalanced. Spot volume often follows. Futures positioning often leads. That's why sometimes price dumps with no news, or pumps when sentiment is terrible. It's not emotion driving the market, it's positioning. And if you don't understand positioning, you'll always feel like the market is against you. In the next part, we'll go deeper into how liquidations work, why the market loves to move against the majority, and how to think differently about spot versus futures if you want to survive long term. But for now, remember this. The market doesn't care if you're right, it only cares if you're overexposed, and that's where most people lose. Most people think liquidations are a side effect of the market. They're not. Liquidations are the engine. When you understand this, the market starts making sense. A liquidation is not a prediction, it's a forced action. When a leveraged position reaches its limit, the exchange closes it at market price. That means instant buying or selling pressure. Now imagine thousands of traders using similar entries, similar stop losses, similar leverage. Those liquidations don't happen randomly. They happen in zones. This is why price often moves fast through certain levels and slows down in others. Slow movement builds confidence. Fast movement cleans the board. Here's something most people never consider. Big players don't enter where retail enters. They enter where retail exits, and exits are usually forced. This is why you'll see price spike into obvious resistance just to reverse hard, or drop below support just to instantly recover. That move wasn't fake, it was efficient, because the market's job is not to respect lines on your chart. Its job is to transfer money from impatient traders to patient ones. Now let's talk about open interest. Open interest tells you how much money is currently locked in futures contracts. When price goes up and open interest goes up too, it means new positions are entering. Sounds bullish, right? Sometimes it is. Sometimes it's a trap. If price stalls while open interest keeps rising, it means traders are stacking leverage without progress. That's a dangerous situation. Because the market hates imbalance, and imbalance gets resolved violently. If you've ever been confused watching price do the opposite of what made sense, comment, "Now I get it," and stay with me. Here's the mindset shift that changes everything. Instead of asking, "Where is price going?" start asking, "Where is the pain?" Pain is where traders are over-leveraged, overconfident, and underprotected. This is why extreme funding rates matter. This is why long-short ratios matter. This is why sentiment is often a contrarian indicator. When everyone agrees, the market disagrees. Now let's connect this to spot traders. Spot traders often think they're immune to this game. They're not, because futures volatility drags spot price with it. Spot doesn't escape futures. Spot absorbs futures. When futures flush, spot follows. When futures squeeze, spot gets pulled up. The difference is simple. Spot traders can survive volatility. Futures traders often can't. And this is where most people blow their accounts. They trade futures like spot. They use too much size. They ignore liquidation levels. They stay married to a bias. The market doesn't care about your bias. It only reacts to exposure. And this brings us to one of the most important truths in crypto. You don't lose because you're wrong. You lose because you're too leveraged when you're wrong. This is why professional traders focus less on prediction and more on risk asymmetry. They ask, if I'm wrong, how much do I lose? If I'm right, how much do I gain? Retail usually asks, where will price go? That question alone puts you at a disadvantage, from guessing direction to understanding structure. When you trade like the market is a puzzle to solve, you'll always feel late. When you trade like the market is a system to read, you start seeing opportunities others miss. And here's the final uncomfortable truth. The market doesn't need you. It doesn't notice you. It doesn't target you. But it will take advantage of predictable behavior. And most retail behavior is extremely predictable. Over-leveraging, chasing breakouts, ignoring risk, refusing to exit. If you remove just one of these habits, your results change dramatically. Not overnight, but permanently. If you want to survive crypto long-term, understand this. Spot is about ownership. Futures is about exposure. One rewards patience. The other punishes arrogance. If you're new, start slow. If you're experienced, stay humble. And if you're trading futures, respect leverage like it's fire, because it is. If this video helped you see the market differently, subscribe and leave a comment. Not for hype, for understanding.